We typically picture moving large sums of money as this, like, highly physical event. You think of armored cars, heavy steel doors, armed guards, right?
Yeah, totally. It feels like it should be tangible.
Exactly. But today, you literally just tap your phone and your money flies across the globe in milliseconds.
And it's completely invisible to the user.
Right. So to figure out how that actually works, today's deep dive pulls from a stack of fintech white papers, some regulatory memos, and API documentation. Our mission today is to unpack the hidden machinery of digital money.
Specifically, we're looking at this concept called compliance orchestration,
which is basically the invisible layer of automated screening built directly into the modern payment flow. The system has to guarantee that international laws aren't being broken.
Right, and it has to do all of that without you, the user, noticing any friction at all.
So the first line of defense in our sources is something anyone listening to this space is already familiar with. That's KYC and AML.
Yeah, the classic know your customer and anti-money laundering protocols.
We know the drill. You take a selfie with your ID, biometric liveness checks run against government databases, and bam, in like 3 seconds you're verified. Let's call our user Maria. She's past the front door.
Well, that initial onboarding is fairly straightforward. I mean, the real heavy lifting comes with the ongoing behavioral monitoring.
Right, the AML side.
Exactly. Let's say Maria tries to deposit $9,800 in cash. And she does this 3 separate times in 24 hours at different ATMs.
Oh, so she's clearly trying to dodge that standard $10,000 regulatory reporting threshold.
Yeah, and the algorithm catches that pattern instantly. It's known as structuring or smurfing.
Smurfing, right.
Yeah, so the orchestration engine compiles all that data and automatically files a suspicious activity report directly to FinCEN.
The U.S. government's Financial Crimes Enforcement Network. So I like to think of KYC as, the bouncer checking your ID at the club door.
Oh, totally.
While AML is more like the casino pit boss, constantly watching the floor for card counters.
That pit boss analogy holds up perfectly, actually. But the thing is, catching domestic structures is only half the battle.
Right. What happens when the money goes international?
Well, if Maria, or say a corporate entity, tries to wire funds globally, the system has to shift to intercepting global threats in real time.
So let's use the corporate wire example from the case studies. Global Tech sends a $250,000 B2B wire to a German company called Miller Logistics.
A pretty standard B2B transaction.
Right. But before the funds even clear, an automated fuzzy logic engine scans the payload.
Which brings us to OFAC sanctions screening. The system checks the wire details against the SDN list.
That's the Specially Designated Nationals blacklist maintained by the U.S. Treasury.
Yeah. You got it. And instead of just looking for an exact spelling match, the fuzzy logic algorithms search for, like, phonetic similarities, missing letters, or even slight name variations.
Wait, searching for phonetic similarities sounds incredibly risky. Like, if I simply share a similar middle name with an international criminal, does my money just vanish into a black hole?
No, not at all. The fuzzy logic is designed to be aggressive, sure, but the orchestration layer is designed to be smart.
Okay, so how does it protect the money?
Well, if it spots a potential match, say a minor shareholder and that German company shares a birth date with someone on the SDN list, it places a microsecond hold on the transaction.
So it doesn't actually seize the funds.
Right. It simply routes that specific payload to a secondary automated queue to verify if it's a false positive or a true threat.
I see. So the money is just paused, not lost. We've established the system is great at freezing out criminals, but our research also highlights how these regulations are actually supposed to make payments cheaper and faster for the rest of us.
Yeah, that consumer shift is really being driven by mandates like PSD3. That's the latest European payment directive pushing for open banking.
And that essentially forces commercial banks to securely open up their financial data pipelines to licensed third-party fintechs. Which brings us to David. Say David is buying a $1,200 laptop. Instead of typing in a 16-digit credit card number and hitting the merchant with a massive interchange fee, he chooses an account-to-account, or A2A, checkout.
Meaning he's paying directly from his bank.
Right. But how does he do that without handing over his actual bank password to some random tech retailer?
Through a secure protocol called OAuth 2.0. Rather than sharing actual credentials, the merchant's checkout system securely redirects David to his own bank app.
So the retailer never sees his login?
Nope. The bank then issues a temporary encrypted token back to the merchant that basically says, David authorized this specific payment.
And under the new PSD3 rules, David approves that token using strong customer authentication, like a quick Face ID scan.
Yeah, it's seamless.
No plastic card, no passwords exchanged, just a biometric nod, and the merchant gets paid instantly with minimal overhead.
And to put the efficiency of all this into perspective, legacy banks used to treat these compliance checks as manual, multi-day operations.
Wow, days.
Right. Today, orchestration platforms execute the KYC check, the OFAC fuzzy screening, and the biometric authentication, all in under 100 milliseconds.
That is insane.
Yeah, and it drops operational costs by over 60%.
We started this deep dive picturing steel bank vaults, but the reality is this invisible web of algorithms moving faster than you can blink.
It really is.
Which leaves us with this final thought. If these behavioral AI pipelines are sophisticated enough to flag cache murphing and intercept global wires using phonetic fuzzy logic in a fraction of a second,
Right.
what happens when that exact same hyper-efficient monitoring is applied to predicting your completely legal but highly personal daily spending habits?